the Maverick Podcast. Welcome back to another electrifying episode of the Maverick Podcast, the show where we unpack today's financial headlines with data-driven insights and a dose of daring analysis. I'm your host, and today's critical question is the Treasury market meltdown forcing the Fed's hand. Today, we're diving into a brewing storm at the epicenter of global finance, the U.S. Treasury market. On April 9, 2025, we've seen a dramatic unwinding of the so-called basis trade, a complex financial maneuver that has suddenly thrust Treasury yields dramatically higher. For the uninitiated, the basis trade involves exploiting tiny discrepancies between cash Treasury bond prices and their associated futures contracts. While these gaps might seem small, traders amplify their potential gains and risks with massive leverage, often using borrowed funds. But here's where things get alarming. Today, yields on the benchmark 10-year U.S. Treasury bond surged alarmingly close to 4.75%. Why is this number significant? Cast your mind back to 2020, when yields spiked similarly, triggering an urgent and unprecedented Federal Reserve intervention. This historical parallel makes today's market movements particularly ominous. The causes of this turmoil are multi-layered and deeply interconnected with geopolitical tensions. Analysts have cited the ongoing U.S.-China trade war and resulting fears of stagflation as primary culprits behind today's volatility. Reciprocal tariffs between the world's two largest economies have escalated tensions, unsettling investors worldwide. However, there's also speculation that Chinese authorities have accelerated their selling of U.S. treasuries as a strategic maneuver within this broader economic conflict. Adding further fuel to the fire, Japanese investors appear to be preparing for what some call a Plaza Accord 2.0, an anticipated global agreement to recalibrate major currency valuations, potentially shifting the landscape of global financial flows dramatically. Now, let's unpack a chilling statistic. Leveraged funds currently hold short positions in Treasury futures contracts amounting to hundreds of billions of dollars, significantly surpassing the high-risk levels witnessed during the turmoil of 2020. Such massive leverage amplifies the potential damage, turning small disruptions into seismic market shocks capable of destabilizing the entire financial system. What does all this mean for the economy and investors alike? Well, this isn't just a niche technical event. It's a flashing red warning about tightening financial conditions and potentially stricter lending standards by banks. In plain English, this could lead to less borrowing, lower investment, and reduced economic activity. Paradoxically, even as Treasury yields surge, longer-term inflation expectations have started declining sharply, suggesting that markets see this volatility as fundamentally deflationary. For equity markets, there's a worrying development. Normally, investors flock to treasuries in times of stock market turbulence, relying on bonds as a stabilizing force. However, the current treasury sell-off is challenging their traditional safe haven role. Should stocks face a sharp downturn now, investors might find themselves with few places to hide, exacerbating overall market volatility. The ultimate question, will the Federal Reserve step in and when? Mark McClellan, chief U.S. bond strategist at Alpine Macro, offers insight here, suggesting the Fed is unlikely to initiate broad-based quantitative easing unless the situation deteriorates drastically. Instead, expect targeted short-term Treasury purchases to provide crucial liquidity and stability if that critical 10-year yield threshold of 4.75% is breached. Simply put, the Fed remains both the first and the last line of defense against broader contagion. Yet this scenario isn't without complications. Aggressive intervention could undermine the U.S. dollar's position as the world's premier reserve currency, raising profound long-term questions about America's economic dominance. As this drama unfolds, investors and policymakers alike hold their breath, watching closely how the Fed navigates these turbulent waters. The decisions made in the coming days could shape not just financial markets, but the global economic order for years to come. Stay informed, stay sharp, and above all, stay maverick. See you next time on the Maverick Podcast.